Regional banks hitting their highest level since December today, and this after Goldman Sachs was the latest of the big banks to report results this morning. On deck tomorrow, we'll hear from Bank of America, Morgan Stanley, PNC, and State Street. Joining us now is former Truist CEO Kelly King. Kelly, always good to see you. What's your assessment of the results so far and the difference between what we're likely to hear from small banks and what we've heard from the big?
Well, good to be with you, John. I've been encouraged with what we've seen so far, very limited, and as you know, the very largest institutions. Volatility around their investment income platform, but overall really strong and likely to be strong throughout the year, barring some collapse in the economy, which I absolutely did not expect. I think the smaller bank earnings will be pretty good. I think you'll see benign credit quality. I think you'll see some relief expressed from the CEOs around net interest margin. You'll see, I think they've talked about beginning to feel the lift of repricing upward assets and if not downward pressure, a definite reduction in upward pressure on the liability side. So I think we may be at the trough with regard to NIM. That's really good for all banks, really, really good for small banks, and likely to set up a situation where over the next several quarters, maybe 2 or 3 years, things are going to look really good for banks.
Tell me more about what you're seeing on net interest margin. I've been somewhat surprised, not concerned, but surprised that more customers of all different sorts haven't been chasing better rates on their deposits than they have. And maybe this is the peak of them doing that. What do you see?
Yeah, so over, John, a 50-year career in banking, I've observed how clients think about interest rates a lot. And frankly, it's not the way, you and I think about it on earnings reports. Most people don't spend a whole lot of time worrying about the level of interest rates until rates get really low or really high. When they're in the normal, moderate range, people don't make decisions about where they put their money based on interest rates. They don't tend to move money around a lot because of interest rates. If rates get extremely low and they're depending on the income, they get more serious about it. And if they get really high, then they begin to shop around because it becomes a meaningful portion of their income. So right now, I think you're seeing still a heightened level of focus, not as much as it was 6 months or a year ago. I think that will begin to wane as we go forward over the next several quarters. And that'll give the banks the opportunity, to have a little less pressure on their NIM.
Okay, so we're getting pretty close to 54 on the KRE, the regional banking ETF. And if we get there, it'll be the first time, I think, since March of 23 that we have been there. Does that signal the reality that the regionals aren't as vulnerable as many feared back when Silicon Valley Bank collapsed, or maybe complacency and we haven't seen the worst of it yet?
No, I think the public in general and those that are investors in stocks and particularly bank stocks are realizing that the quote unquote bank scare was not a systemic issue. It was isolated to a few institutions that had idiosyncratic issues. There was worry that it might be contagious, but that is not proven to be the case. I'm not at all surprised about that. So I think people are beginning to see that, number one, banks are resilient. Number two, they didn't have the kind of exposure that people really scared about. And number three, when the economy is doing pretty good, which it is, and you potentially are right on the cusp of lower interest rates and maybe a better regulatory environment, it's getting to look really good for banks, and I think people are seeing that.